Hello friends, this is Dr. Amarjeet Kaur, Professor of Accounting at the Department of Management, Gurugram University, Gurugram. It's my privilege that I am here with you to talk on financial institution. So we are, carrying this series on financial management, under which we are talking about financial system, which comprises financial institutions, and many more aspects. So we will be getting into details of all the parts of financial system. So the agenda for today is financial institutions. So friends, in any economy there are many players, be it a producer, a consumer, a regulator and so on. So every player has certain roles. Consumer make demand, producers produces for them, supplies, and then that's how the economic activities are going across in any economy. Especially in a capital economy, there's a demand for funds to produce, to fulfill their desires an individual has or a company has. So certain part of the economy would have surplus funds and certain part of the economy at any given point of time would have shortage of funds, right? So there comes in a need of a system which ensures the flow of funds from the from the surplus part or to the part where we have no shortage of funds. That particular system is known financial system. Now, financial system has many components, many pillars in it. It comprises financial markets, financial institutions, financial services, financial instruments and regulatories. So, there are so many pillars. So, one by one we would be addressing all these pillars. In the past we talked about financial markets and today we are going to talk about financial institution. So, this is the background for your understanding, right. So, the financial institution is important aspect, important part of financial system. So, what financial institutions are? Financial institutions, they serve as intermediaries between those who have capital to invest or lend and those who have need of funds. So, facilitating economic activity by enabling savings, investments and efficient allocation of resources. So, these institutions, they are serving as intermediary. They are supporting the flow from surplus to the shortage sector. So, between those who need capital and those who want to lend, who have surplus. So basically these institutions are facilitating, they are supporting economic activity of movement of funds. They are supporting, they are helping us to save because banks they accept our funds. So, they are enabling savings, they are enabling investment and then they are efficiently allocating the resources. So, for example, if I deposit my surplus money in any month in a bank, so what are they going to do? They are lending further to who need it, right. So, bank is a very good example of financial institution. So, they are allocating to whom? They are efficiently allocating to those who are in need, because the bank would really review the proposal, will see the business plan, will see the business has potential to generate revenue, enough revenue in fact, and return back the money which is going to be lent by the bank. So, that's how the efficient allocation of resources is possible, becomes possible. So, this is what the financial institutes serve as. Financial institutions, they are pivotal to the growth of economy and thereby they are governed by government regulations. Bankruptcies of financial institutions can lead to a panic situation. Central and state agencies and sometimes multiple agencies, they regulate same institution. So, it is not that always all the time one institution is governed by the central or by a particular state agency. There is a possibility that these financial institutions are governed by both central agency as well as state agency. It all depends the purview of the agency we are talking about. And nevertheless, these institutions, they really play a pivotal role in the growth of any economy. And since they are so important, if they fail, a panic situation can be can emerge in a market, in a country. So that is why the governance of this financial institution is very important. For that matter, Indian financial system is considered to be very robust. We had seen many bubbles, many kind of recession or in the world in the past decades, in a couple of years ago, and our system was least affected because of the governance we had of financial institution in our economy. Further, these financial institutions, they connect, to make it very simple, they connect savers and borrowers in a capitalist economy. And these institutions are, could be a company, a banking company, a non-banking company, which are involved in financial and monetary transactions, so such as loan, investment, deposits, even insurance, brokerage, investment, etc. So that's how these financial institutions are working. If I add more, a financial institution is in the business of facilitating financial and monetary transactions such as deposits, loans, investments, and currency exchange even. They include banks, insurance companies, asset management companies, brokerage firms, and investment banking firms. So, we call them as FI, financial institution. FI is a commonly accepted, this word. FI, they are actually in the business of facilitating financial and monetary transactions, be it deposit or be it loan, be it currency exchange even. So, even that comes under the purview of financial institutions, and these services are provided by banks, by insurance company, by asset management company, by investment banking firm, brokerage firms. There are so many so many different type of businesses which are involved into this financial system we are talking about as financial institutions. Now, what are the main roles, main functions of financial institution? As I said, they are very important. They play a pivotal role in any economy. So, it means they have a great role to play. There are so many functions they perform. So, now I am going to talk about functions of financial institution. First, they provide, the first function of financial institution is providing depository services. Second, providing payment and settlement services. Third, providing lending services. Fourth, providing financial advisory. Fifth, providing risk mitigation services. Sixth, creating money marketplace. And seventh, creating asset market place. Eighth, allocating capital. Ninth, facilitating economic activities and growth. And lastly, number 10, providing pension fund services. So, I will be discussing these functions in detail now. The first one is providing depository services. So, this is the most commonly availed services by all of us for majority of the individuals living in any country, in India especially. There were times when many people were not under the formal financial system. Now we have financial inclusivity because of Jan Dhan scheme and many such schemes. Majority of the people are now included into formal financial system, right? So, financial inclusion has become a very wide practice as of date. So, it means we are using financial institutions. If I say financial inclusion, it means one or the other financial institution is playing a role there. So, be it a cooperative bank or a commercial bank, a private bank or a public bank. So, we can deposit with them, right. So, that is the first important aspect. The savings can be deposited in financial institutions, be it bank or a cooperative bank or a foreign bank or an Indian bank, right. So, and we can earn certain amount of return in as the form of interest on that, on those deposits. That is the first function known to all of us. Even a person who has never gone to school even would, that person would know that bank is doing this particular service. So, that is a financial institution's role or function. Then the second function, as I said, is providing payments and settlement services. Payments, like if I want to transfer money, like nowadays most of us are using online services, Paytm or any rupee, any such platform where we are paying online to a vegetable vendor, to a big purchase of any car, etc. We can pay online. And what is happening? Who is providing these services? There is some bank involved in it, right? You may have bank in X, you may have an account in X bank or Y account. You are paying through us, online, but there is some intermediary which is playing an important role. So, payment is possible. Forget about the online one, the current, the latest, these latest developments. Even in the past, when we were very youngsters, we were students, even then if I have to pay something, we were using checks, drafts. Even today many payments are still being made by checks, by draft or online. Who is providing, who is enabling you to make payment for your rent or for your purchase of a shoe or pair of shoes or pair of jeans or even in house. So, from a capital investment to a recurring expenditure, we are making payments, and these payments are enabled by a financial institution, right? Even the settlement of services, settlement are possible. For example, you can discount a bill, somebody gave you a check, you can go and get the money from them, somebody gave you a draft, you can get the money and you can demand a money, same equivalent amount of money as mentioned in the instrument from the bank. You become the owner of that money and you can go and demand. That check becomes a promissory note, right? So, this is the second function. The third function is lending services. The money which is collected by a bank or a cooperative bank or any type of bank or a non-banking financial institution, that is lended further to the needed person, right? So, the another important role, deposit and lending are the two primary old roles which we all are familiar with. So, that if I need to buy a house, a car or for education, I can reach out to a bank and ask for loan, right, be it education loan or car loan or a housing loan, and bank would be providing you that service. So, that is the third important function, that bank would be lending you money, or any financial institution would be lending. It's not only the bank, there are there are institutions of national importance. Even the LIC would be lending to another company, or there would be SIDB or any such any such institution who would be providing term loans for long to any business for 15 years, 20 years. They would be sponsoring projects. It's not just the lending for a small need of a car, etc., but it could be requirement of thousands of crores, right, where institutions like LIC, SIDB, etc., they play a role. They provide term loans, they sponsor projects, they actually lend money for such projects of national importance or importance to any company. So, that is the third function. The fourth function any financial institution would play is providing financial advisory. Here, financial institutions like those institutions which help you understand. For example, nowadays even banks are doing, they have a counter where you can go and buy insurance policy. They have a counter where you can actually buy any SIP plan. So, there would be somebody who would be helping you understand these available options or plans, and actually they are advising you. Or there could be a non-banking private firm which is into the advisory role. They are helping clients to invest their savings in different portfolios. They are developing portfolios for you. So even that is the activity of financial institution. That was the fourth point, fourth function. The fifth point here I want to make is the risk mitigation services. So what are risk mitigation services? So risk is mitigated means bank would underwrite or undertake to pay on your behalf. You know, LCs are opened. So LC may have the letter of credit is opened where bank assures to the supplier that in case of any issue I would be paying you the money for the supplies made to any company here in India, right? Or otherwise, you know, it could be a local risk mitigation as well for for purchases of machine or otherwise, you know, machinery, plants, etc., or for even for supplies. The risk is mitigated by undertaking, you know, through various instruments. This risk mitigation is possible. So this function is known as risk mitigation services. Is also becoming, and in fact has become very popular because of the capital economy we have in India, and this is very common everywhere. So this was the fifth function. The next function is that they are creating, the financial institutions are creating money market place. So the commercial papers, treasury bills which are sold in the market are sold through banks. You know, even the share market, you know, if I go to the capital market, this was the money market. Even the capital market, the shares can be, you can invest through, you know, if the IPO is there, you can invest through a bank, like that. So creating money market place where financial financial instruments are traded. So that has been created with the help of financial institutions, right? So that is an important function. People who are invest in shares, they would know how important this function is. Then creating asset marketplace. So assets, when I say assets, I am talking about the financial assets, right? Different financial assets we have discussed in the past, we will be discussing in future as well. So the marketplace where the financial assets, be it derivatives or be it futures, etc., etc., can be traded, can be sold, purchased. Even financial institutions are playing a role there. Then the next function which financial institutions play is allocating capital. You know, allocating capital is resource allocation. So from the surplus sector to the sector which has you know, shortage of funds. So the capital gets allocated automatically through this you know, vehicle which is created. This vehicle which we call as financial institution, they work as instruments, or they call as instrumental, they call as vehicles to move funds from surplus to the shortage sector, you know, or company or any part of the economy. So this allocation of capital becomes possible. Even they would be using their you know, different parameters. Mostly there's a concept of 7 C's which banks follows. They review proposals for the, you know, applications which are made for loan. So they review it from many perspectives, and thereafter they allocate capital. And fortunately now our NPA has come down because of this you know, prudent approach which has been adopted in the banking system, in financial institutions for that matter, bringing non-performing assets to a significant lower level, which it used to be a decade ago. So we are seeing an improvement here, but the capital allocation is very you know, wise, very prudent, very effective because of the financial institution. The ninth point, the ninth function financial institutions play is facilitating economic activities and growth. You know, economic activities are so many, be it production, purchase, sale, consumption. These all are economic activities, and they, you know, purchaser, buyer, consumers, producers, they all are economic agents, right. So, financial institutions are really facilitating each of the economic activity. Imagine you are yourself as a consumer. You want to buy a car, you are a consumer of that car. You want to buy a refrigerator, new refrigerator, a new TV, you are a consumer, right. Or you are a producer of that TV and the car. Both need funds. Both are economic activity. Consumption is an economic activity, production is also an economic activity, right. And these economic activities are doing what? They are, because of the economic activity, the growth happens, right. Growth happens because there is a demand, and because, so there is a prospective consumption, which means we anticipate demand and we produce. Another economic activity that we sell, we facilitate through supply chain, we facilitate the movement of those produced products and and services from the point of production to the point of sale, wherever the end consumer is. So, these all are economic activity, right. So, these economic activities are facilitated through financial institutions. Imagine we, an apple is been produced in Kashmir or in Himachal or in Kangra or Kulu, right, and it reaches to us in Delhi or even the far away places in any small part of the country. That is also economic activity, right. Woolens are produced in Panipat or in Ludhiana and in Punjab, and they reach to the last part of the country in Kanyakumari or in Delhi or in any part of the country. How is it happening? These all are economic activities, right. Something is produced at one place, is moved not only within the country, in overseas. There are many countries where we are exporting, importing goods and services. So, these all economic activities, movement of products, services, consumption, production, sale, etc. is happening, and this all is leading to economic growth. Economic growth is primarily based on the demand and supply. If we have demand and we are unable to have supply, the consumption based economy, nowadays our country is growing because of the consumption, and consumption is because of the population we have, and we have very young population. Not only the population, we have young population, the dividend of these young people we are generating, we are taking, right. So, we have those benefits. So, these all economic activities which I just mentioned are enabled by financial institutions. The last thing is that they also provide, financial institutions, they also provide pension fund services. So pension funds is basically savings during the working life of a person, and then getting it when you are retired, your post, when you superannuate. So, be it national pension scheme or be it the employee provident fund or otherwise normal pension scheme, all these schemes are actually helping you to save for your post retirement life. So, even that service is provided by financial institutions. The last part I want to talk about is importance of financial institutions. All the discussions which I have made, it actually talks about the importance of financial institutions. There are many points which I will be covering in the subsequent talk in future, but just want to summarize that financial institutions, basis on the functions we just discussed, we discussed 10 functions, they play a very important role. They are important to the growth of economy, they are important to the mobility of funds, they are important for consumption, for enabling supplies or enabling operations. For every aspect of the business, financial institutions are important, right. So, the first importance of financial institution is financial intermediation. These financial institutions, they play as an intermediary role. They play as an intermediary between the surplus and the deficit sector. The second important function or importance of financial institution is that the credit provision is possible. The third is risk management, fourth is payment systems, and fifth is economic stability. So, credit provisions are possible because credit means seeking loan. So, that is the importance of financial institutions, that they help us in providing credit to the needy people. Risk management becomes possible because they perform the role of underwriters. Debentures are issued, some financial institution is playing the role of underwriter. They undertake that we will be paying you back your deposits if the the person who is taking the loan or the company which is taking the loan fails to pay that. So, risk is mitigated, risk is managed. Even payment systems have come up, be it the online payment system or be it the physical system. These systems are possible because of the financial institutions. That is the importance of financial institutions, that they help us develop payment systems. And then we have economic stability because of them. Otherwise, it would be a chaos in any economy. Imagine what happened in USA in 2008. There was a bubble which is known to all of us. Because of that, the economic instability occurred, because that was failure of financial institutions, that the loan was lended at the underlying assets which were not having saleable value. Then there are many points in the importance of financial institutions, that they help in price discovery. It is possible to find out the price of the products. They ensure liquidity, right? Liquidity means ability to pay, for the immediate demand. Even that is enabled by financial institutions. They offer safety to all of us. They create employment. These financial institutions have given employment to so many people. You see so many insurance companies are around, so many cooperative banks are there in villages, so many banks, private or public, are there. So, they are creating employment. The last importance point, the point for importance is they are promoting equality. Regional equality is possible because they help us develop economy, they help us develop industry, according to the geographical location, according to the possibility of production in that sector, or availability of labor, availability of raw material. So, all these, because of these things, they are helping us to generate industries in those areas where otherwise it would not have been possible, because they are enabling funding of industries. So, that leads to regional stability. So, these were the points in favor of importance of financial institutions, and this is the time to now wind up. I hope you were able to understand what are the roles of financial institutions and what is the importance of financial institutions. Time to sign off. Thank you very much.